So it's that time of year where, in every 4 years, where people tend to sit there and say, "Hey, what is the impact of the presidential election going to be on the markets?" And I think, given the fact that we've had such a chaotic year, if you will, it's a real fair question. In general, the markets are pretty much politically agnostic. Basically, the market follows profits, and that in general is the case. But I saw a report from Fidelity that I'm going to show you here that came out here in the last month that I thought was quite good. And it was talking about when you have a Republican or a Democrat in the White House, where their party is completely in control, or their party is divided between the House and the Senate, how that ultimately works out. And I think what's interesting to note is that whatever the differences over the outcomes are within a 2-year period, it's amazing how they tend to level out after 4 years. And in general, if you look at this first side, left-hand side of this graph, and you look at the annualized rates of return, and by the way, this data goes back to the 1850s. But if you look at the annualized rate of return, typically the third and fourth year of a presidential term is typically the best. But I do think it's interesting to note, as I was saying, that whatever the differences are in outcomes over the first 2 years following a presidential election, they pretty much have disappeared by the time a full 4-year term goes into place. So, for example, on average over the 2-year period, the market does just a little bit better following a Republican win, about 8.3%, than a Democratic win, about 5.8%, in the first 2 years of a presidential election. But if you look in year after 4 years, they're about even, about 8.6 to 8.8%. Now, the contrast is a little bit more extreme when there's a sweep, when the Republicans tend to win and have control of both the House and the Senate. The 2-year average forward return is about 12% a year. And when the Democrats have that happen and they're in control of the House and Senate, it's only about 3.5% a year. But again, having said that, you look 4 years down the line, and typically the returns are very similar between parties, and it doesn't make that much difference. We can also see a difference between some of these gridlock scenarios. So if a Republican win happens without a majority, a so-called divided setup, without a majority in the House or the Senate, then that's produced a 2-year forward return of only about 1%. Conversely, when the Democrats win with opposition in Congress, they typically have a forward return of about 14% in those first couple of years. But again, over a 4-year period, it tends to average out quite a bit. So it is interesting because I think it's important to think of 2-year scenarios and to look at initially, and then to think of a full 4-year scenario. Again, you got midterm elections 2 years from now, so things can change quite a bit. What typically is not the best scenario for the markets, believe it or not, is one party controlling for 4 consecutive years. It usually is a license just to spend money. This is a really good report. Fidelity put it together. We'll be happy to get that to you if you'd like it. Again, my email is ray.evans@pegasuskc.com. We hope that you're staying safe and enjoying what you can of this summer, and we'll look forward to talking to you soon. Thanks very much.